Gold doesn't change. We all know that. An ounce of gold, is an ounce of gold today, and 10 years from now it'll be an ounce of gold, but maybe the 10 years from now the price will be 30,000 per ounce. Gold hasn't changed. What has changed? And the value of the currency is changing as we speak. The only thing that would mitigate further increase in the price of gold is a huge deflationary event where the amount of currency is cut by a large number, like 50%.
Renowned precious metals expert David Morgan recently highlighted a fundamental truth often forgotten in the noise of market speculation. Gold itself doesn't change. Currencies do. An ounce of gold today is the same ounce it was a decade ago and will remain the same in the decades to come. What fluctuates is not the intrinsic value of gold, but the purchasing power of the currency it's priced in. As Morgan explains, when we see gold's price rise, it's not because the metal suddenly becomes more valuable, and it's because the currency used to measure it is losing value. The global monetary system, built on ever-expanding fiat issuance, continues to erode the purchasing power of money at an accelerating pace. Central banks worldwide are trapped in a cycle of debt monetization and inflation, ensuring that over time the price of gold will only reflect the continued decay of fiat confidence. The only scenario that could temporarily halt or reverse gold's rise, he notes, would be a massive deflationary collapse, an event so severe that it would wipe out half the circulating currency supply. Short of that, the trajectory remains clear. As currencies weaken, gold doesn't just preserve wealth, it reveals the truth about value itself. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.
People that have wealth will buy gold. People that don't have a lot of wealth will buy silver. And there's a lot of people, a lot more people that only have a few thousand, a few hundred to buy or purchase hard currency with or hard metal with than have the ability to buy, $100,000 worth of gold. So I think you will see more and more people buying silver for that monetary asset. And that's when it moves away from its base case, where as an industrial commodity, it sells for the cost of production or slightly more. I think anyone that's just coming into the idea of gold that we just outlined, why is gold going up? And it starts to catch on to the story and understand what we just discussed. To move that into silver is a little more difficult. The reason being is that most people understand gold is money, or they have some association with gold, but very few people, unless they're my age or older, really think of silver as even having a monetary aspect. And it hasn't in a lot of ways. I mean, I have many in my peer group that say, well, silver is just an industrial. It's not, you can't call it. I differ with them. But my point is this: it is both an industrial commodity, but there is a point that will take place, in my studied view, where the monetary aspect of silver becomes the most important part of silver. And that's because the depreciation of the currency is so great that people will buy anything and everything that they can instead of holding on to their currency, as I said earlier. And they'll move into a hard asset. People want it for security, safety. We think about what is the amount of demand for money, and the amount of demand for money is actually infinite. The reason it's infinite is people depend on money, or currency now, but money really, in order to survive. I mean, there aren't many communities outside of, Aborigines, even the Amish use some. So when you think you need it and you must have it, which we all more or less believe, but what you're holding is a false representation, something of value, and you start moving that 1 or 2%, or even 3 or 4%, it could get that high, into a market as small as the silver market, price is indeterminate. I mean, it really is, because there's so little silver relative to the potential demand of infinity that people that wake up and say, oh my goodness, I'm going to buy 2 jars of peanut butter, but I got my life saving is $12,000. I can buy, 3 gold coins, or I can buy this much silver. So I think the gold silver ratio will continue to come down, meaning silver's favor will go from like 85 to 70. I'm looking at 70 as kind of a turning point, and then down to 60, perhaps 30, and maybe even to the historic classic monetary ratio of 15 or 16 to 1. And if that happens, the silver relative to gold will be like a 4-fold in relative to gold. In other words, it'll perform much. And I do believe that will happen, but I don't know. So in that case, I think you should make sure you have both gold for wealth preservation, silver for wealth preservation, but also that beta, that high volatility that may take silver far higher, because we could and will probably see silver used as a means of transaction before the new system reset, or perhaps even after, where people are willing to deal in silver coins or bars for goods and service, be it renting an apartment or maybe an automobile or perhaps even real estate. I don't rule that out. I think, in fact, you might see that more and more as the Great Reset starts coming toward us at a fast confidence in the US dollar being able to be worth something in the future. And we all know that's a lie. It's not true. And so that $1 that you have in your pocket today should be spent for something of substance now, rather than holding it for a T-bill or a T-note or a T-bond where you've got 6 months or 5 years, 10 years, 20 years, 30 years. Because if it's losing value rapidly now, why would you hold it any longer? Haven't hit that point yet, but that trend is very, in fact, I've written about it or talked about it here very recently about how few of our major purchasers on an international level are buying as much U.S. debt as they did in the past. Japan is, China is, most of the major nation states are not. And what are they doing? They're buying gold, and they know gold is going to hold its value. It doesn't change, it just maintains.
In a powerful reflection on the global monetary shift, David Morgan explains the widening divide between those who buy gold and those who turn to silver. The wealthy, he notes, seek stability and preservation through gold, a timeless store of value. But for the everyday saver, silver remains the gateway to protecting what little purchasing power they have left. As currencies lose credibility, silver will no longer trade merely as an industrial metal. It will re-emerge as a monetary asset. Morgan emphasizes that while gold is widely recognized as money, silver's monetary role has been forgotten by most, except for those old enough to remember when silver coins actually circulated. Yet, as global confidence in paper currencies continues to erode, that perception will change rapidly. When even a small percentage of people move their savings from fiat into silver, a market this small will face massive price pressure to the upside. He believes both metals are essential: gold for long-term wealth preservation, silver for monetary momentum and transactional potential in a post-reset economy. As trust in the US dollar fades, people will increasingly exchange paper for tangible value. The question is no longer if, but when. Let's get into the interview.
They're valued right now as if gold is like 3,000 the ounce, not 4. So that's almost a gimme. It's almost a guarantee. If these stocks or these companies, their bottom line is higher than they're being valued at, then it's a value. It's a value, and that's what they are right now. Yes, they've gone up a great deal. They got hammered pretty good on this recent pullback, and that's really more opportunity. So I think if you really want to catch up to the people that bought silver at 30 and gold at 3,000, you'd be better off buying the mines. You want to be careful. You want to be very selective, and you really want the blue chip. That's why I think I've been more successful than some of the people in my space, because I've emphasized from the beginning to weight the portfolio to cash-rich, unhedged mining companies, particularly the royalty and streaming. For example, my favorite silver investment's up 25-fold. Well, the silver itself performed as well as that streaming. Silver be at $125 the ounce, not 50 or thereabout. So that proves, in that one instance, I only need to prove one data point to make a case. But I have several that are not that high. That's our best performer, but in the 20 times, 15 times, 10 times, which is similar to what silver is. And we do more than silver stocks. We do uranium batteries, rare. But anyway, coming back on point, yeah. That's really the best place to be right gold. But if gold's overvalued relative to everything, then obviously you can buy stock, you can buy real estate, you can buy a business, you could do whatever. If you're wealthy, you could start a foundation, you could, be a philanthropist and give money away. There's a lot of things you could do with it, but I haven't got a pat answer. But I really wouldn't want to take it and put it necessarily in a bank for currency for very long. Because unless we know the value of the currency is stable, we really don't want to change gold for something else. But that doesn't mean you want to hold on past the overvalued, area either. So it's a challenge. But, people are smart. I mean, buying a business is probably the best. But I would not discourage anyone from doing, free enterprise stock invest. I mean, there's value stocks out there. There's always new ideas. And then save in real metals. So you put that $50 away every month in silver. And then if you want to invest after you've gotten a certain level of money and $1,000 or whatever, you start with your $1,000, and you got to apply the principles. You don't buy $1,000 worth of one stock, but you do that, but you diversify. I'd say 5 or 6 is really all you need.
In today's volatile markets, the real opportunity may not just lie in owning physical metals, but in understanding where true value hides, and that's within the mining sector. As discussed in the latest market breakdown, many top-tier mining companies are currently being priced as if gold were only around $3,000 an ounce, far below its potential valuation. That disconnect creates what some analysts call a once-in-a-cycle entry point. Despite recent pullbacks, this phase isn't a signal of weakness. It's a setup for strength. The correction has opened doors for investors to accumulate shares in cash-rich, unhedged miners and royalty or streaming companies, the blue stars of the metals world. Historically, these have delivered exponential gains, often outperforming gold and silver themselves during bull runs. The strategy is clear: save consistently in real metals and diversify smartly into quality miners for leveraged growth. In times when currencies lose ground and inflation chips away at purchasing power, tangible assets remain the ultimate safeguard. Whether it's gold, silver, or the companies that mine them, the key is to hold what endures when paper wealth fades. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.